Hello everyone, welcome and thank you for being here today. I'm excited to introduce our presentation titled Break of Structure. My name is Bilal Safdar, and I'll be guiding you through this session. We'll explore some fascinating ideas about how breaking traditional structures can lead to new opportunities and innovations. Over the next few minutes, we'll cover the key concepts, strategies, and real-world examples that illustrate this approach. So, let's get started and dive into the world of breaking the mold. Today, I want to talk about the concept of smart money and how it helps us understand market movements more effectively. One of the key ideas here is the break of structure, or BOS, which is a crucial tool for identifying the intentions of institutional market players. When we see a BOS, it often signals a shift in market direction driven by larger players like banks and hedge funds. BOS serves as a core pillar of smart money concepts because it allows us to gauge where the market is headed based on actual price action, rather than lagging indicators. Price movements are driven by real market demand, meaning when institutions step in, they create noticeable changes in the charts that we can interpret. It's important to understand that the market is primarily driven by liquidity and order flow. These are the forces that push prices up or down as institutions seek to execute large trades without causing too much disruption. Smart money focuses on reading this price action directly, rather than relying on delayed signals that retail traders often use. Speaking of retail traders, it's worth noting that many common indicators are lagging. They tell you what has already happened, not what's about to happen. In contrast, smart money concepts emphasize following the actual price behavior, which gives us a more real-time understanding of market trends. Finally, we need to recognize that institutions like banks have a significant influence on market trends. Their actions, moving liquidity, placing large orders, shape the overall direction. By understanding how these institutional market movers operate, we can better anticipate market moves and make more informed trading decisions. Let's start by looking at BOS, or break of structure. This indicates a significant change driven by institutions, signaling that big players are shifting their positions and influencing the market direction. Next, we have BOS as a structure violation, which essentially confirms that the previous trend has been broken and a new trend is beginning. Moving on to LL, or lower lows, these show persistent downward pressure in the market. When you see lower lows forming, it suggests that sellers are still in control, pushing prices lower over time. Similarly, LH, or lower highs, reflect resistance levels in a declining price trend. This pattern indicates that each rally attempt is met with resistance, reinforcing the downtrend. Now, market structure reveals a lot about institutional intentions and positioning. When we analyze these patterns, like lower lows and lower highs, we get a clear picture of whether institutions are selling or buying and how they're positioning themselves in the market. On the flip side, we have HH, or higher highs, which indicate ongoing upward momentum. When prices create higher highs, it's a sign that buyers are gaining strength and the uptrend is active. Finally, HL, or higher lows, signify strong support and a potential continuation of the upward move. These higher lows suggest that even during pullbacks, buyers are stepping in at higher levels, keeping the bullish trend intact. All of these elements, structure violations, highs, and lows, are fundamental in understanding market behavior and institutional intent. Recognizing these patterns helps us anticipate potential future moves and align our strategies accordingly. Let's talk about the break of structure, or BOS, and why it's so important. Recognizing a real BOS versus a false signal can make a big difference in your trading decisions. Sometimes, the market appears to break out, but it's just a temporary move or a false alarm. Filtering out these false breakouts from genuine moves helps us avoid unnecessary risks. A BOS typically signals a potential change in market direction. It can serve as a crucial confirmation whether the trend is continuing or reversing, giving us a clearer picture of the market's next move. Remember, institutions often drive these structured movements, so a break of key levels can be a sign that big players are stepping in. That brings us to the institutional participation indicator. When a BOS occurs, it usually involves the price breaking through significant levels, like previous highs or lows, that have been validated over time. If the price breaks a previous high or low that has held firm, it's a strong indication that a new trend might be starting or an existing one is gaining momentum. So, understanding these key points about BOS and recognizing when it truly signals a market shift allows us to align our strategies with the broader market structure and institutional activity. Let's take a closer look at the BOS in uptrend. What we're seeing here is that institutional participation is really driving the market's upward movement. When institutions actively add buy positions during this phase, it signals strong confidence and a solid foundation for the trend. Now, breaking the previous high is a crucial point. It confirms that the upward momentum is ongoing. When the market decisively surpasses the last high, it reinforces the idea that the trend is still strong and likely to continue. This break of the previous higher high is a key confirmation that the bullish trend is intact. It's important because it boosts confidence among traders and investors, making them more comfortable with the idea that higher prices are ahead. This confirmation of the trend continuation provides clarity and reduces uncertainty. Overall, what we're seeing is a strong bullish market structure. The price action forms a pattern of higher highs and higher lows, which is a classic sign of an uptrend. These patterns indicate consistent buying pressure and a healthy upward trajectory in the market. So, in summary, the combination of institutional buying, breaking previous highs, and the formation of higher highs and higher lows all point to a very robust bullish trend. Let's take a closer look at the concept of a BOS, or break of structure, in a downtrend. Understanding BOS can really elevate your market analysis, helping you identify potential trend changes early on. When we monitor these signals, it becomes easier to make more effective trading decisions because we're staying ahead of market moves. A key point here is that a break below the last lower low, or LL, often signals a continuation of the bearish trend. When the price drops below that previous LL, it confirms that the downtrend is still intact and possibly gaining strength. This is critical because it indicates that sellers are in control. Institutional traders, who are often the big players in the market, tend to capitalize on these bearish movements. They actively add sell positions during this pattern, aiming to maximize their profits as the market moves downward. Recognizing this behavior can give us insight into the strength of the trend. This pattern of lower lows and lower highs consistently appearing is a clear sign that the market sentiment remains strongly bearish. It's a visual confirmation that sellers are pushing the price lower over time, reinforcing the overall downtrend. So when you see these signals, lower lows, lower highs, and breaks of structure, remember, they all point to a strong bearish market sentiment, and understanding this helps you align your trading strategy accordingly. Now, let's delve into the comparison between BOS and MSS. When we see a trend confirmed by a BOS, it gives us a solid indication that the market is likely to continue in that direction. However, it's important to remember that institutional validation is required to truly trust these signals. This step helps us ensure that we're not acting on false breakouts or transient moves, and it clarifies the overall market direction. When these signals align, they can point us toward potential trading opportunities, giving us a clearer picture of where the market might be heading next. Moving on, the concept of a continuation pattern indicates that the current trend is likely to persist, which is crucial for timing our entries. Now, shifting focus to the market structure shift, this is a key concept because it often signals a trend reversal. A change of character is a specific signal that suggests something fundamental is changing in the market's behavior. This change typically precedes a break of structure, which confirms that a new trend might be forming. So, in summary, understanding these signals, whether it's a trend continuation or a shift in market structure, helps us read the market more accurately and prepare for potential reversals or continuations. It's all about recognizing these key moments to make more informed trading decisions. All right, let's talk about what makes a valid BOS, or break of structure, rule. First off, it's crucial that trades happen during active market conditions. This means we want to avoid ranging or low-volume sessions because these can lead to unreliable signals. When the market is moving actively, it gives us a clearer picture of true price action. Next, a valid break must close past the previous level. This closing price is what confirms the break, so we need to pay attention to candle closes beyond key structures. Candle close beyond structure is absolutely crucial because it signals that the move isn't just a quick spike, but a genuine shift in market sentiment. Now, it's important to look for breaks that follow a significant liquidity event. These events act as catalysts, making the break more meaningful and validated. Usually, this occurs after a liquidity grab, something that temporarily pulls liquidity and then creates the perfect setup for a real move. And finally, the price movement itself needs to be robust and decisive. We're talking about a strong, impulsive break that shows conviction. This isn't a hesitant or weak move. It's a clear indication that the market is shifting in a meaningful way. So, in summary, for a valid BOS, we want active conditions, a candle close beyond structure, confirmation following a liquidity event, and a strong, impulsive move. These rules help us identify high-probability setups aligned with the overall trend and market dynamics. Let's dive into some common mistakes that traders often make and how we can avoid them. First, a lack of liquidity awareness can really lead to poor trade entries. If you're not paying attention to where the liquidity is, you might enter a trade too early or too late, which can cost you. It's crucial to understand how liquidity moves and how it influences price action. Next, overlooking liquidity considerations during market moves is another big mistake. Sometimes traders focus only on the price action itself, but ignoring how liquidity is building or leaving the scene can cause you to miss the bigger picture. Another point is about wick breaks. Many traders see a wick break and think it's an indication of strong momentum, but often, wick breaks can be false signals. They don't always reflect true market strength, so relying solely on them for confirmation can be risky. This leads us to the importance of higher timeframes. Higher timeframes give us critical insights that can help validate our trades. They provide context that might be missed on lower timeframes, helping us make more informed decisions. Ignoring this higher timeframe context is a common pitfall that can lead to false signals and ultimately, losses. If we don't consider the bigger picture, we're more likely to trade against the overall trend or market momentum. Finally, trading break of structure within consolidation zones is tricky. Consolidation zones are ranges where price moves sideways, and breaking structure within these zones can be misleading. It's important to recognize that not every break signifies a real move. Sometimes, it's just a false breakout within the consolidation phase. By being aware of these common mistakes and understanding their impacts, we can improve our trading approach and avoid unnecessary losses. All right, let's talk about protecting your trade by setting a proper stop loss. It's crucial to place your stop loss beyond the structure, meaning you want to give your trade some room to breathe, but not so much that it becomes risky. Make sure that the candle closes beyond the previous structure to validate the move. This confirms that the breakout or breakdown is genuine. Next, you want to confirm a break of structure, or BOS, with a candle close. That candle close signals that the previous support or resistance has been broken, giving you more confidence in the trade direction. After that, wait for a retracement back to a key level. This is often where price pulls back before continuing in the trend. Once it pulls back to an order block, those areas of previous interest, you can look for entry points on the pullback. Ideally, you want the price to grab liquidity, which often happens just before a strong move. Keep an eye out for a liquidity sweep event, where the price temporarily takes out stop-loss orders before moving in the intended direction. Now, regarding the BOS entry model, it's all about establishing the market's direction before you jump in. First, identify the trend on a higher time frame because that gives you the bigger picture. When you align your trades with the overall trend, your chances of success increase significantly. So, in summary, always set your stop-loss beyond structure, validate the break with a candle close, wait for retracements, and confirm liquidity grabs. And remember, understanding the overall trend helps you enter trades at the right moments, making your trading more strategic and less risky. Let's talk about BOS and liquidity. Essentially, institutions execute trades based on their access to information and their strategic foresight. They have a significant trading advantage because of this. This advantage means they can anticipate market movements better and act accordingly. As a result, retail traders often find themselves entering the market later, after a move has already started. Sometimes, they miss those early opportunities because they're reacting to the market rather than predicting it. Understanding how institutions behave can really help us identify trends earlier. If we can align our trades with what the smart money is doing, we can make better decisions. Institutions tend to look for areas with high order flow, places where a lot of buying or selling is happening, to make their moves. And during market movements, institutions prioritize liquidity. They want to trade in areas where they can enter and exit without too much slippage, which is crucial for their strategies. So, by paying attention to institutional behavior and liquidity, we can improve our ability to read the market, spot opportunities, and trade more effectively. It's about understanding that the big players often set the tone for the market, and we can benefit from recognizing their patterns. Let's do a quick recap of what we've covered. Adopting institutional strategies can really improve your trading outcomes. By thinking like institutions, you start to see the bigger picture and make smarter decisions. Understanding market structure is crucial because it helps you make more informed trades rather than guessing blindly. Always aim to trade with context. This means looking at the bigger picture and not rushing into decisions without proper analysis. Using higher timeframe insights gives you a clearer view of the market's overall direction, so always align your trades with these larger trends. Remember, institutions are the ones driving market trends through their strategic moves, and recognizing their control is key. The break of structure, or BOS, is a strong confirmation that institutional players are taking control, signaling a potential shift or continuation in the market. Overall, by applying these principles, you're positioning yourself to trade more effectively by understanding the underlying forces at play.